All right, I've got 6 o'clock, so why don't we get started? So thank you very much for joining. So I'm Mark LaMonica. I look after the individual investor business for Morningstar in Australia. Tonight, we're going to do a market outlook. I'll explain the agenda and what we're going to go through, but a couple things first. Anything you hear today is general advice. I obviously don't know anything about you. I can't offer personal advice. If you're over in New Zealand, you can get a copy of our FAP on our website, morningstar.com.au, and the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you want personal advice. So thank you guys for joining the last of our January series of webinars. So to kick off the year, we did a couple things. We talked about some investing resolutions for the year. We looked at portfolio construction, and then we've got this market outlook webinar for tonight. Next week, we will kick off a month focusing on ETFs. So if anyone's interested in that, sign up for those webinars. You can email me if you have any questions at mark.lamonica1@morningstar.com. Also, despite the general advice warning, it'd be great to get questions. So if people do have questions, you can send them through in the chat. You can send them through in the Q&A. Saw one come through on the chat already asking if last week's webinar is available, and they all are recorded. So these are available for everyone. They're on our YouTube site. If people don't have access to that, once again, send me an email and I can send you the link. And this one should be up in a couple days. Normally we get this Tuesday one up by Friday. So, all right, let's get started. So as I said, we're going to do a market outlook this evening, but we're going to do it a little bit differently. And I'll go through the agenda items in a second. There are obviously lots of market outlooks that come out in December and January. Most of them are focused very short term on what the market is going to do during the year, and generally include some sort of prediction about market performance. Well, obviously, markets are completely unpredictable. Anyone who is making one of those predictions is just guessing. And so in my mind, there's limited value to that. So we're going to do a couple different things tonight. So we'll look at what's happening in markets. So we'll look back over the past year. It's obviously been a fairly turbulent year. So look back on that, and then kind of what's happened in the last couple months where things have changed direction a little bit. But then we're going to go back and try to provide some perspective. And I think that that's really important for investors. It's important to have that perspective in order to understand how short-term and longer-term trends in the market impact your ability to achieve your goals. So we'll spend some time looking at valuation. So look at valuation. We'll look at investor expectations because, of course, investor expectations are going to drive a lot of that short-term performance. So it's important to take a look at that. And we'll talk about if any of that actually matters over the long term, because of course that's our focus as investors, is investing over the long term. Then we're going to go through some considerations just around what's happening right now. But once again, send through any questions that you guys may have as we go through the presentation tonight, or as I go through the presentation tonight. All right, so we're going to start out looking at what has happened in the last year and the last month. And this is based on US data. Now, the US market, if you look at what's happened in the last year, the bear market that we're reading so much about, of course, has happened in the US, as well as some international markets. We never got to bear market territory in Australia. The Australian market, and we'll focus a lot on the Australian market tonight, but the Australian market has performed a lot better. But of course, how global markets perform impact a lot of investors' portfolios. They also impact, of course, what we see locally as well. So what these two charts show, one looking at the last month, the one looking back over the last year, is divides up the share market on two different measures. So number one, looking at value, blend, and growth shares. So once again, value shares are the shares with the lowest valuations in the market. Growth are the ones with the highest valuations in the market, and blend, of course, is in between. And then we also look at across different sizes of companies, so large cap, mid cap, small cap. So that's talking about market capitalization. So how much a company is worth, and that's how we categorize across those different categories. So the interesting thing that has happened in U.S. markets in particular is over the last year, we have seen a big shift in performance, with value significantly outperforming growth. And this is very different from what we've seen since the GFC. So if we go back and look at the GFC and we look at how markets have done since the GFC, it's generally been very well. There obviously was that COVID hiccup that we had in March of 2020. That was a bear market in Australia, in the US, internationally, but it was very, very short term and things kind of bounced back immediately. And what we've seen is we have seen a rotation back into value. So you can see in this 1 year number that we've seen large scale losses in a lot of growth shares, and we've seen pretty significant outperformance, while still negative, but outperformance in value. And things have reversed themselves in the last month. So the interesting thing is, we've seen this flight from a lot of technology shares, a lot of the more speculative shares, a lot of shares that have cash flows and earnings expectations that are well out into the future. So that's why they're growth shares, because they are growing faster. That's why they trade at higher valuations. We've seen really the market run away from that in the last year and focus more on some of those value names. We've kind of seen the opposite happen, as you can see over the last month. So I think it's just important to frame what has happened. We'll talk about why and how different things, including central bank policies, including just general risk appetite, have impacted both of those groups of shares. And so, yeah, we've seen this big reversal in the last month. So if we turn our attention to the ASX, you can see, and I'm using VAS, so Vanguard Australian Shares, as a proxy for the ASX. So obviously that does include fees as well. But when we've looked at Vanguard Australian Shares, we can see our our performance since October, we've seen a pretty big reversal and really strong performance out of the market. So up over 11% in Australia over that time period. So we have seen a pretty big bounce back. A lot of that has come from investor fears dissipating. Now, whether that is founded or unfounded, whether that will play out or not is yet to be seen. But we saw a pretty big bounce back in the Australian market. When I go over and look at the S&P 500 in the US, around that same time frame from the beginning of October until earlier this week, we also saw a very strong bounce back. So actually outperformed the Aussie market, even after such a bad year in the US. So up more than 13.5%. So it's just a little context about what has been happening in markets, and of course around investor expectations, which we'll be talking about. So it's important to remember always that the market prices in the future. So it's expectations of investors about what's going to happen in the future is going to influence that market performance. So as we go through today and we talk about those expectations, remember, it's not necessarily what has happened in the past. The market is forward looking, and the market can certainly look forward past events that may happen. And we saw this very quickly during COVID. There was a lot of fear, obviously, in February and March of 2020 about what the impact of COVID would be. I think it's safe to say that the impact probably was a lot more significant than any of us thought at the time, but markets did bounce back really quickly. And they bounced back really quickly because people were looking past what was expected to be a temporary but severe economic contraction. And of course, a lot of that economic impact was actually blunted by actions from central banks. So I do have somebody saying has the seminar started. So Randall, hopefully you can hear me. We did start, but anyway, remember, everything's forward looking, and that's the perspective that we'll be taking today. I want to turn our attention to valuation. So valuation is really important. We're going to spend some time talking about valuation. And valuation, of course, refers to what different parts of the market and the market in general is trading for. And that has a lot to do with investor expectations. So there are lots of different valuation measures. I'll talk through a couple different ones that we're going to explore, but really we're looking for how much is an investor ultimately going to pay for a dollar of earnings, pay for how much a company is worth. So first I wanted to start out with the ASX, looking at our Morningstar analysts. So quickly, what our Morningstar analysts do is they are going in and they are valuing, and they're using a discounted cash flow model to do this. They are valuing the different companies within their coverage universe. And they are trying to figure out what something is worth, and then they're comparing that to what it's traded. So obviously, as investors, what we're really looking for is we're looking to buy great companies at good prices. So basically, we want to buy things for less than they are worth. And what this does right here is it takes a sector breakdown, and this can explain a little bit what has been happening. It takes a sector breakdown on valuation. So quickly, what these numbers mean is on the left-hand side, we have performance across each one of the sectors in the Aussie market. And then we have valuation measures. So when we see a valuation of 1, that's what we call the price to fair value. So 1 would mean that the share is trading for what we think it's worth. We think it's worth $20. It's trading for $20. When we see valuation measures from a price to fair value perspective that are above 1, we believe that that security, in this case, the sector roll-up, is overvalued. It is trading for more than we think it's worth, what our analysts think it's worth. And of course, conversely, when we see something that's below 1, we believe it's trading for a discount. It's trading for less than what something is worth. Now, the Aussie market, and we talked a little bit about the rotation we saw in the US market going from growth to value, a lot of those growth being companies operating in the technology space, for example. Aussie market's a little bit different, of course, just because of the makeup of the market. So as I'm sure all of you are aware, the Australian market is dominated by the banks. So the big 4 banks, dominated by BHP, but also the other miners. So BHP, which makes up over 10% of the local indexes. Those are the big parts of the US or the Australian market. So you don't really see as much technology exposure in Australia. And so that's also one of the reasons why we probably did not see the losses that we saw in the US, and also because the Australian market was trading at a cheaper valuation level than the US. And there's a lot of that froth that built up in the outperformance in the US that has reversed itself. And that really led to those valuation differences. But a couple of things to point out. You can see the areas that did not do well in the local market. So obviously, it's balanced out overall, and Australia did not have that bad of a year. But you can see even though the small parts of the market, they don't make up a lot of the index and that overall index performance, we can see a terrible year for technology, communication services, which in many ways is a proxy for technology. So in fact, a lot of the large US shares that people think are technology shares are actually in communication services. So that includes Alphabet, which is Google's parent, Meta, for example, Facebook. So we've seen really poor performance there. We've seen really poor performance in real estate. And there's been a lot of concerns around interest rates going up around real estate. So we have seen poor performance there. But obviously the standout that's jumping off the page, some of these traditionally more defensive sectors, but particularly energy. So I don't have to tell anyone that we did see a surge in energy prices, especially after they were so low during COVID. So a lot of that's the economy opening up again, but that's also, of course, the impact of the war against Ukraine and the sanctions against Russia. All sorts of different issues there have pushed up energy prices and, of course, led to a lot of the Australian energy providers doing very, very well. But if we go back over and we look at valuation measures, which is really what we want to look at as investors, because valuation measures have a huge impact on the returns you're going to get in the future. So there's study after study after study that looks at and classifies shares by valuation. Now, these are Morningstar valuations. We'll get into some sort of broad-based market valuations later. But you can see some of the sectors, especially energy, even after that outperformance. So it got more expensive, right? So it was at a 31% discount here. It's now at 21%. It's still an area that our analysts see a lot of value. We're also starting to see value in technology, of course. So it went from overvalued to undervalued. So about 9% overvalued, and then about 23% undervalued. So this gives you kind of a sector view of both performance and how that impacts things. So from an energy perspective, even though there was such outperformance in energy, even though it did so well, we still think it's cheap. Technology, conversely, because it performs so poorly, we think that there are actually opportunities there. And we do have a lot of reports, obviously, going through the specific ideas that our analysts have. Kind of spend most of today focused on sort of macro and looking at the market overall. But I'd be happy, obviously, to send, we did do an outlook that came out in December that looked at some specific names and looked at some of those sectors. So I'd be happy to send that to anyone if they are interested in it. You can just drop me an email. We flip over to the US overall, and you can see a little less than 1% down, close to 20% down in the US. Once again, the US significantly underperformed last year. Now, we were helped a little bit by the Aussie dollar, which has started to come back, but the weakness in the Aussie dollar. So remember, as Australian investors, we want Australian investors that are investing globally, we want the Aussie dollar to fall. So that adds to returns. Doesn't make trips very fun overseas, but it does add to returns. So a lot of Australians invested in the US did not see this degree of loss because it's counteracted a little bit by the Aussie dollar. But you can see in the US, in many ways, the same story, very strong performance from energy, and then huge issues with communication services and technology, as well as consumer cyclical. So that's obviously concerns about the economy, a cyclical share, a share that goes in the consumer cyclical market. And we saw the same thing in Australia, down close to 21%, just more pronounced in the US. So something cyclical, it follows the economic cycles that we go through. So these are companies that would not perform very well during a recession. And of course, there's a lot of fear about recessions last year. And then when you start looking into places our analysts do see value, you can see that once again, still on a relative basis, they see the US market as being more overvalued, or closer in this case, higher valuations than what they see in the Australian market. And that's actually reflected, and we'll talk about this later, in our view about long-term returns, where we're actually seeing better chances of long-term returns because of cheaper valuation levels in Australia than what we see globally. And globally, of course, is dominated by the US. So it makes up around 70% of a global developed market index that you may buy. So once again, you can see some opportunities in technology where we think it fell a little too much. Same thing in communication services, but largely the valuations are actually higher. All right, so let's keep going. So let's talk about overall, and I took this from JP Morgan because I thought it was a really good chart. Let's look at overall valuation. We're going to use two different measures, and we're going to use two different measures because the one I really like, we don't have great data in Australia for. We'll get to that next for the US. But if we look at the price to forward PE ratio, so what that means is what we're looking at is projected earnings. So projected earnings by analysts. Now, this is different than sort of the model that our analysts use, where we're looking at their actual fair value. That information generally is not public. But now we're just looking at a pure price to earnings ratio. So what is an investor willing to pay for a dollar of forward earnings, a dollar of earnings that we expect a company to generate in the next year? And we collectively as analysts expect it to generate. So what you can see is the Aussie market is about average in terms of where it's been. We go back all the way to 1999. And so certainly I don't think that there's a view that the Australian market is incredibly cheap, but we're trading at about an average valuation level. Now, what we need to consider as investors is where did that average come from? Because there are, of course, all sorts of different impacts on valuation. So, of course, one impact, of course, is the level of interest rates, which we're going to talk about in a second. We see about an average valuation level, and we've seen that come down. Now, of course, if we go back to sort of this 2020 period, we did have a steep fall initially, but a lot of that has been also just earnings, of course, going up. So earnings recover. So remember, with any valuation measure, any relative valuation measure, there are two sides to it, right? There's obviously price, which is how the market fluctuates, but then there's also that earnings, which changes, of course, over time. goes down often when we're in recessions. When the economy is doing really well, obviously corporate earnings generally go up. So just remember, we have those two different sides. So we're about an average valuation level right now. And you can go back and look at some different measures that JP Morgan is using as well. So dividend yield, of course, dividends, as long as they are maintained, dividend yield goes up when the market goes down. It goes down when the market goes up. About average, price to book, which is really looking at sort of assets at a high level, assets minus liabilities of the company, about average. Same thing for price to cash flow. So pretty much everywhere we look, we are seeing a pretty average valuation level for the Australian market. If we flip over to the US, I'm using something now called the CAPE ratio. So for people that have tuned into the podcast or gone on these webinars, I really like the CAPE ratio because I talked about one of the issues when we're looking at those relative valuations, like a price to earnings, is that the earnings fluctuate a lot. And earnings fluctuate a lot across the economic cycle. So what I did is I went back and looked at 1990, and this measure, the CAPE ratio, which I'll explain in a second, is made famous by a professor, Professor Schiller in the US, and you can go get the data. So I just created this chart myself. So if we go back and we look all the way back to 1990 and look at that CAPE ratio, we can see it's fluctuated a lot. This, of course, is the internet bubble that we're seeing popping up around 2000. This was sort of the post-COVID bubble, if we're going to call it that. So with the pretty steep falls in the US, once again, we've gone back to a little above average in terms of valuation level. So the CAPE ratio is around 29 right now, where you can see back to 1990, that average is around 26 and a half. Now, the reason I like the CAPE ratio, I talked about that fluctuation in earnings, is, and what CAPE stands for, is cyclically adjusted price to earnings ratio. So in order to smooth out those earnings fluctuations we see across the business cycle, the CAPE ratio actually goes back and looks 10 years back at earnings and averages them. And obviously what that does is it smooths out those earnings across that business cycle. So it's one of the reasons I like looking at it. It's one of the reasons a lot of people like looking at it. This is certainly not something unique to me. But once again, when we look at the US, we can say trading a little above the average CAPE ratio back to 1990. Now, we're going to talk about some of the different things that have happened over that time period, because I think it's really important to put that into context. All right, so let's look at short-term investor expectations. So anyone who's been following the market knows that a lot of the volatility that we saw in 2022 really came from expectations about interest rate rises. So really entering the year, of course, there was the expectation, and the expectation was because central bankers came out and said it very famously here in Australia, said it would be years before we would see interest rate rises. But a lot of that volatility was kind of investors coming to grasp with what was happening. So remember, we entered 2022, everyone said inflation was going to be transitory, rates wouldn't go up. Australia especially waited, the Reserve Bank especially waited longer, and most people think too long, than a lot of other global central banks to raise rates. But now we need to look forward and see what those investor expectations are. So Australian investors expect that there's going to be some more rate increases. So overall, people think it's going to go up from around 3.1% or 3.1%, not around 3.1% today, where we're sitting, to 3.8% by September. And then rate cuts will actually follow. Now, there is a lot of different opinions. I just listed 4 of them with economists associated with the big 4 banks around what will happen. So we've got ANZ, Westpac thinking we'll hit 3.85 as a peak. NAB a little more conservative at 3.6. And then CommBank basically saying the expected next rise of a quarter point will be it. So there obviously are some different expectations, but what we're looking at overall investor expectations is that 3.8. So I think over the short term, certainly that is going to be something that will drive markets and how that plays out. And kind of the plunge we saw at sort of the end of the year, particularly in the US and global markets, was people realizing that, you know, a lot of central banks are very serious about getting interest rates up. in order to combat inflation. So something that we should look at over the short term. We're going to talk in a second about what we should look at over the long term. So going back historically, looking at interest rates and what the equilibrium might be if we go back and look at history. Because while we're very focused now on what will the RBA raise in their next meeting, how high will it go? Will they actually cut this year? Same thing with the Fed, which you can see below. Well, there is a lot of expectation around that. Over the long term, as investors, we need to think about where interest rates are going to land. And we went through a long period, which will show a very low interest rates. Now, low interest rates increase valuation levels. And I'll talk about why in a second. So because low rates do that, the higher the rates are, generally, the more valuation levels come down, which is, of course, bad for us as investors. And the reason for that is that when we are valuing a company, the value of a company that we buy are cash flows that that company generates in the future. So, of course, when we're valuing that company, we need to discount back those cash flows, right? Because it's great that the company's going to earn money in the future, but we're worried about what is that worth now? Just like if somebody came up and said, I'll give you $500 today, or I'll give you $500 in a year, what do you want? You would take it today. Which means we need to discount stuff that happens in the future that we expect to happen. And that discount rate we use is, of course, influenced by interest rates. So the higher the discount, the less things are worth in the future. That brings down those valuation levels. That's why this is really important. So kind of the same story in the US. Rates are higher right now. They're expected to go higher, up to 5%. But once again, there is an expectation that starting around October, the Fed in the US will actually have to start cutting. And a lot of that expectation is around, number one, inflation getting under control, and also the economy slowing. And I will say that our chief US economist at Morningstar agrees with this assessment. So agrees that rates will start to come down in the US in the Aussie spring. The other thing, of course, that's out there are expectations around recession. So Bank of America does a global fund manager survey. So they're going out and asking professional investors what their expectations are. So 66% of them, this was in December, said that they would expect a recession in the next 12 months. Now, this is the other thing that's really driving markets short term is, are we going to have a recession or not? How severe will that recession be? And of course, the fear about that recession is in response to rising interest rates. So we'll talk about Australia in a second, but obviously in Australia, we do have a lot of variable rate mortgages, or certainly shorter fixed terms than the US, where a 30-year standard fixed rate is. So very simply, that's one way that higher interest rates impact the economy, less money for people to spend. We'll get to that in a second. So these are kind of investor expectations. And as these investor expectations change, remember, because it's always expectations of the future, as they change, then of course, we're going to see volatility in the market. And so the fact that investors have been sort of pulling back, as we've seen better inflation signs, as they've been pulling back on those interest rate raise expectations, you've seen the market do better. And you've actually seen, as we saw on that first chart, you saw a lot of the things, those growth shares, do very well. A lot of the stuff that had been doing very well got slammed last year. Kind of seems like everyone's trying to forget that any of this has happened and just going back to what worked. We'll have to see if that continues to work. So I'll pause for a second. We've got a couple of questions. So Lisa's got a good question. So Lisa says, will the inflation peak signal a stock and bond value market pivot point? Yeah, I mean, I think certainly over the short term. So, inflation is why interest rates are going up as much as they are. The worry, of course, as I said, is that will slow economic growth. Interest rates going up, of course, make bond prices go down. We had a really poor year in bonds last year. So, yeah, I think certainly, and we'll have to see over the long term and where inflation settles, but certainly that would turn the market. So if we're looking at inflation expectations, and obviously there's the headline numbers that everyone's looking at, and then everyone's kind of looking under the hood as well. Like, where are those different areas of inflation? So yeah, at least I would agree that that would be a pivot point. So maybe we've already reached it. So of course we've got a pretty good rally going in fourth quarter and so far this month, which is ending today. I think a lot of that's around investors feeling more optimistic around inflation, which makes them feel more optimistic about how high interest rates will go and when they can be cut again. And Rodney says only if we don't have negative interest rates. Yes, well, there's certain people that are very worried about that as well. So there's a couple of questions in the chat from Peter. So I'll quickly do this. Do you use companies forecast cash flows? If so, where do you find it? Our company forecast cash flows realistic. So no, the forecast cash flow. So a company, yes, will put out guidance. So a company would generally put out guidance for the next year, maybe beyond that. But really, that is what an analyst's job is. An analyst's job, and all the different analysts at Morningstar and everywhere else, are trying to forecast far out into the future what companies will generate from a cash flow perspective, because that's how a discounted cash flow model works, which is the way people value companies. So you are forecasting out those cash flows years into the future, and then you're discounting them back. So there's nowhere to get them. And that's why there's very different opinions based on where you go from valuations, because people have different opinions about what a company will do. They have different opinions, of course, around the overall market environment that the company will operate in and what will influence that. So we have another question. The bank's interest rate forecasts are correct. Why are they offering up 4.65% on 12-month term deposits and more for longer periods, 2.89% at call? Okay, so the interest rate forecasts we're looking at there are the Reserve Bank overnight cash rates. So they're very important. So this is how central banks try to control interest rates. They're very important, of course, but that's not the rate you get, right? So I think as everyone sees out there with mortgages, it's just because it's 3.10 right now. That's not what people are getting when they're rolling over out of the fixed term of their mortgage, right? So obviously, the source of funds that banks are using to go out there and fund their loan books is a lot of it is things like term deposits. So they're really looking at that spread, right? Their net interest margin between how much they are sourcing funds from, a lot of it from depositors, especially in Australia, and then how much they're actually going out there and issuing mortgages for. All right, so yep, so Rodney said that as well. So I keep saying that Rodney needs to come in here and just do this for me. It would be easier. So I'll get to a couple more questions. I'll get to those in a second, but let's keep moving. All right, so let's go back and look at the historic RBA cash rate, because I think a lot of investors, certainly when we start talking about rate cuts occurring in the latter half of this year, the latter quarter of this year, is a lot of people, of course, wish rates would go back to where they were from the GFC, but also particularly during COVID. So famously, the RBA brought rates down during COVID to 0.10%. So very low and obviously very different from where they are today and where they're expected to be. But if we go back and we look historically, and we'll talk about the implications in a second, if we go back to 1990, the average cash rate was 3.85% over that time period, even with a very low rate kind of happening after the GFC. And rates did not drop as much early as they did in the US, which we'll look at the next chart. But I do think as investors, we do need to realize that those rates that we looked at after COVID are probably never coming back. And that even though there could be certainly cuts later in this year, raises later on, that we are probably looking, once again, looking historically, and we'll talk about the link in a second, we're looking at higher interest rates than maybe some of us in the short term became very used to. And I think it is important to look at that from a valuation perspective, particularly because obviously rising valuations are pluses for us as investors in terms of returns. And we got a lot of those, but are we still going to get that? Well, if you go back and look historically, rates have been a lot closer to where they're settling into, and a lot of the forecasts are settling into for Australia. We go back to the US, we saw a very pronounced and longer low period of interest rates, followed by some rises, then once again a drop down to zero basically during COVID. And so once again, the US, because rates were kept for so long between that post-GFC period, if we go back to 1990 again, so 2.775. So the US is actually higher than what that average was. But once again, that period of very low interest rates was longer in the US. And obviously because the US suffered a really severe recession during the GFC, where Australia was able to dodge that, even though, of course, returns were really poor here. So once again, and if I stretch this back even further from 1990, didn't want to go back too far, you can see those average rates are higher. So the question is, are we just moving into what traditionally has been more of a normal range around interest rates? And a lot of those valuation driven returns we had in shares just are not going to happen again. So just something to think about in terms of going back historically. The two other things I think we need to think about, and we'll talk about the implications in a second, is along with lower rates, and these are all related, along with lower rates, and this is where I could only find data from the US, but similar things have happened in Australia. It's been a very, very good time period to be an investor. And it's been very, very good for lots of reasons. One, we've had high valuations because we've had very low rates. The other thing is companies have done very well. And we really were in this environment where an outsized portion of the economic pie started going to companies. So basically what we're looking at right here is we're looking at two different lines, and this is percent of GDP or percent of the overall economy, and who's getting it. Right? Because there are different groups that, of course, capture different parts of GDP. So one thing is it can be wage earners. So if we have relatively high salaries, that means more of the overall economic activity that's occurring is going to people that are working. And they're getting that, of course, through their wages. It can also go to government, which is not on here, but of course, government can take that up with taxes. But the other place it can go, of course, is it can go into corporate profit. So if corporations make more and more, they're capturing more and more of that overall economic pie, that is very good for us as investors. So obviously there's a lot of political connotations around this. A lot of this has to do with the inequality that we've seen. But basically a lot of that is because, of course, there's smaller numbers of people who are owning companies and owning companies through shares than people that are out working. So when we see those outsized pieces of the economic pie going to corporations, that benefits shareholders, right? So if we are shareholders, and I assume most people on here are, that has really benefited us, right? Because we're capturing more of the economy. And there's all sorts of reasons for this. And we'll go through some of the reasons in a second. But, a lot of the reasons, of course, is just, what is wage growth? And, reason we hear a lot is, of course, with the declining power of unions, it's made it harder for collective bargaining, which of course gives workers more power. And of course, stuff flows to the company, pieces of the economy or percentage of the economy has flowed to companies. So the question is, of course, is where is that going to go from here? But you can see if we go back over a long time period, it is a lot higher. So during this very good period for shares, it's been a lot higher. Plunge during, this is the GFC right here, this plunge where corporate profits went down significantly. But overall, if we kind of look at the average, we have seen more of the overall economy go to companies rather than people who work at companies. The other thing I think we need to look at, and we're sort of setting this up to talk about whether we are in fact in kind of a pivot point for the economy and what we can expect for returns going forward. The other thing, of course, is a profit margin. So a profit margin simply refers to a company is going out there and selling goods and services, and they keep some of that. Some of it goes to expenses to pay their workers or run their factories and pay everything else a company needs to do, taxes, etc. But of course, some is kept at the end in profits. And of course, who do those profits go to? Well, the profits go to us if we're shareholders. So if you look at profits from companies. So this is in the S&P 500. We've seen that profit margin has increased significantly lately. So once again, we've seen this big run up. Saw the technology bubble, that burst, and we've seen this huge run up. Now, if you look under these numbers, there's three different places that this has really come from, and how we've gotten from an average or a median of 8.5% up into this really high profit margin. And so a couple things have happened. So the first thing, of course, is taxes matter. So companies, of course, pay taxes. Their taxes eat into a profit margin. We have seen cuts in corporate taxes. So that's one thing that has happened. And we've also seen, of course, just reductions in interest rates. So the less, of course, that a company pays to go out and borrow money, the more profit it earns. So those two have been drivers. But the biggest driver out of this, which I think we need to think about, the biggest driver out of this is the composition of the S&P 500. That means the companies that are in it changing. So 44% of this increase in net interest margin from the median here, 44% of that came from the fact that the S&P 500 is more and more made up of technology companies. So talked about sort of the US, the heavy technology composition of US markets, made up of technology companies who, of course, have higher profit margins. And this is why investors love technology companies. And a very simplistic, but I think good way of describing this is that if you are at Microsoft and you create a new, whatever it's called now, Office software, right? It takes a certain amount of people to do that, right? So you've got developers out there and they have to develop the code that go into this. But then the amount that you can scale that is, well, basically unending. Meaning that if it takes 10 developers to create code and you sell 1 million of them versus 20 million, a lot of that just goes into profit. There are some marginal costs associated, but technology companies are very, very profitable if they can reach scale. And of course, we've seen a lot of these giant technology companies emerge in the US. So whether that's social media platforms like Meta, of course, whether it's Google, whether it's Microsoft. So you've seen these sort of dominant technology companies that have been able to expand that margin. So a lot of it has really come from that, which is interesting. And sort of this argument going back and forth is, are we going to see reversion to the mean in terms of profit margins, or will this continue to happen? So as we get more and more technology companies, as more things, as we turn from sort of a creating goods economy to a service economy, are those profit margins just going to keep expanding? And I guess the other side of that simplistic example, of course, is we go back into whatever, the 1970s, where sort of software became such a thing. And a lot of companies had factories, right? That limits how much they can scale things profitably, because of course they have to go build a new factory if they want to make more stuff. Microsoft doesn't have to do that because it's software, right? Facebook and Instagram don't have to do that because it's a platform that, of course, they can get more and more and more users onto it, so they can have more and more advertising. That stuff just scales. So the question is this really just economic changes and the changing nature of companies and what we consume? Or, of course, are we going to see that reversion to the mean? And so, there's arguments either way, right? So there's certainly arguments that corporate taxes will come up, given how indebted a lot of countries are right now. So yeah, that's kind of the thing. Of course, with interest rates going up, that adds to cost as well. So another thing to think about as we're going through this year, and a thing to look at. All right. So I want to finish with some considerations for investors, and I'll get to some of the questions, so send those through. And we'll talk a little bit about each one of these. So if you have an opinion or a question, certainly go through this. So, or certainly send them through. So post GFC, which I tried to look at in a number of different ways. And once again, it's kind of ignoring that COVID blip, right? But if we look at post GFC, and even if we go back and look at kind of from the post internet bubble popping, we've seen a lot of different things happen. But one of the main things we saw happen is we really saw the relationship between interest rates and inflation. We've seen that be severed, right? So traditional economic theory, of course, tells us that if interest rates are cut, then we will see inflation. And throughout history, that's generally what happened all the time. And then we've really seen that go away. And we saw it go away once the last bout of inflation was crushed in the early 80s. But we've really seen that accelerate post GFC, early start from 2000 as well. And we had these long periods. And when I went back and I showed you that chart of the US, we had these very long periods of very, very low interest rates, and there was no inflation. Now, the question right now, and talk about some of the drivers that I have talked about before. The question, of course, is, was that a historic anomaly? And if it is, then that means we can count on higher interest rates and, of course, changes to valuation because of that. Was that a historic anomaly? And we are back to that relationship where central banks have to be very, very mindful. It's not just interest rates. Think about everything else, right? All the fiscal stimulus we've seen, the cutting of taxes, as well as, of course, sorry, I lost my train of thought. All of the different things that have happened. And the question is, why did we have that relationship? And I just saw a comment came through that certainly captures what a lot of this was, it was a lot of different structural things that were happening. So number one, of course, we talked about before, it is certainly wages. So I think workers have lost during this time period. And a lot of that is with sort of collective bargaining going down. So of course, if you can keep wages down, you can keep the cost to produce goods and services down. Wage inflation can get into a spiral. But I think a lot of it is globalization, which the comment hits right on the head. So if you think about what happened in this period, we had accelerating globalization. So what that means is, number one, we had China, and we had China point that out, but also some other countries. We had originally the offshoring of manufacturing. So of course, there were cheap labor sources that could be exploited by companies and benefit us as a consumer to get cheaper goods and services. So simply, used to be build a factory in China, you make stuff for cheaper, you ship it wherever you're going to sell it. And that kept inflation under control, is actually exporting deflation, which is what the comment said. The other thing is then we had that accelerate into services, right? So whether that's moving, if it's offshoring, started out with call centers. Now it's really been around a lot of different things are offshored. Once again, not great for workers, particularly in developed countries that have higher wages, but good for consumers because you can get goods for cheaper. So we saw a lot of that. We saw huge increases in world trade. And a lot of that, in many ways, people are saying may have reached a peak. And we've seen all sorts of different stats showing how trade is going down. All sorts of things around COVID, right? So certainly things where there were blockages to trade. We've also seen kind of those natural increases in wages in a lot of these developing countries, but also a lot of countries took a look at what happened during COVID and said, we really can't do this anymore. We really can't be completely dependent on a country like China, for example, making everything, because that makes it very, very difficult when there's something like COVID and there's an emergency and you can't get masks because you don't make any of them in your country, right? So there has been a lot of nationalism. There has been a lot of populism. So of course, Trump is a famous example of that. A lot of that came out of the anger from a lot of workers who were seeing their jobs disappear, et cetera, seeing wages not grow. But all those different effects, whether it's geopolitical tensions, whether it is more economic nationalism, whether it's populism, there's an argument out there that I think is pretty credible that a lot of that growth we had, a lot of that deflation that came from globalization is not necessarily going to happen anymore. And it doesn't necessarily have to completely reverse, but it does mean that if you're not seeing that anymore, it can't counteract things like really low interest rates. And yeah, I agree with Phil's comment is that, yeah, deglobalization equals inflation, right? It equals going back to that historic relationship between interest rates and inflation. So what does this mean to us as investors? Well, I think that we need to figure out right now, the market, of course, always, and all of us as investors, right, we have recency bias. We kind of expect what recently happened to continue happening. And I think the mindset of a lot of people, if you look at it, especially around these rate cuts that people see coming later on, the fact that for so long, every economist told us that inflation was transitory, is really that recency bias influencing investors' behavior. So I think the question this year, and when we're talking about interest rates and talking about what's going to happen this year, but the question this year is not necessarily what each rate rise is going to be. The question is sort of where does inflation settle, right? We had a very high reading recently in Australia. There's all sorts of people explaining this away, but where does inflation and interest rates settle in terms of that equilibrium between them? And my bet is, and I think a lot of people are betting, is that it's going to settle at a higher point. The counter argument to that, which Rodney jumped on, is he says it's also possible AI, so artificial intelligence, becomes a new method of replacing workers. So Kathy Wood, who is a very famous fund manager, that's her argument. So her argument is, in a lot of this, in a lot of inflation, a lot of deflationary stuff has been around technology, right? And around efficiency and not having to grow workforces as much, even if they're domestically based, if you're in a developed country. But her thought certainly is that artificial intelligence is the next thing, right? So of course, if you have artificial intelligence and it's cheap to deploy and it replaces a ton of workers, then once again, that's deflationary. So that could be a situation if we have that deflationary element to things where we could see, once again, interest rates settling a lot lower. Of course, it would be good for us as investors, not so good for us when a robot replaces us at work. But yes, that's certainly, and certainly as Rodney pointed out in his comment, really around those knowledge economy workers who were not as affected as much as workers in manufacturing, for instance, in a developed country, because there's thought that their skill sets could not be outsourced or offshored. Now we saw some offshoring, but yeah, is the next revolution artificial intelligence that will be able to do that. So that's really those two arguments, but yeah, certainly something that we will see. Is this a structural shift or is this kind of a blip? The other thing, of course, is around the economy. So we do need to remember that while we're very much concentrating on interest rates, that they do have a delayed effect to work their way through the economy. And I would say Australia in particular, once again, as we talked about earlier, because of how mortgages are structured in Australia, we see that impact even more. And so with these very short fixed terms, I don't need to tell anyone about this, these relatively short fixed terms, we're of course seeing a lot of people that are resetting to higher rates. And this, of course, has huge economic impacts because, of course, it is going to slow consumer spending. So a lot of people are looking at kind of this cliff that another 500 billion of fixed rate mortgages in Australia will expire by Easter. And of course, that's going to be less disposable income that can work its way through the economy. Now, a lot of people are saying that, of course, is going to prevent the RBA, for example, from raising rates too much and will force them to lower them. But once again, we have to see if inflation is actually under control. Another element that probably is underappreciated is this notion of TINA. So TINA stands for there is no alternative. So while rates were very, very low, and that, of course, benefited borrowers, and it also, of course, benefited companies that were borrowing, it benefited us as investors because valuation levels went up. A lot of that is because a lot of money that used to be in the bond market went into the share market. And the reason it did is because nobody could earn any returns in the bond market, right? So when you're going out there and interest rates are so low, we talked about the term deposit example earlier, but on an even higher level than just us deciding whether we want to put something in a term deposit is, of course, institutions. And institutions have shifted a lot of money into the share market. Now that, of course, yields are higher, so we can see what's happened with 10-year Aussie government bonds. We've seen 10-year treasuries. significantly higher, those rates start looking attractive. And of course, that's going to shift money out of the share market into the bond market. Even though we saw really big losses last year, now interest rates are higher. So what could that do, of course? Well, that could once again suck money out of the share market as more people decide that, hey, these yields are looking pretty good. And exactly, just like the comment, chasing yields. So the question is, how big of an influence did sort of that notion of Tina, there's no alternative to invest in the stock market? What happens when that goes away and it pulls money out? So I think that'll be a very interesting thing to watch out this year that could have long-term implications, obviously tied up with interest rates and everything we've talked about. And then the most important place, of course, is what impact, if we have higher inflation and lower future returns, what impact does that have on all of you? And so obviously, whether we've calculated it or not, we do have return expectations and expectations in our head around the returns we are going to achieve from our investors, from our investments. Now, we talked about lots of different arguments both ways, why this may happen, may not happen, et cetera. But one thing to think about is, okay, how does higher inflation, how does lower returns impact you? So I put a couple Morningstar figures in here. So we raised last year our 30-year inflation expectations, annual inflation, from 2.2% to 2.8%. Why does that matter? Well, it matters, of course, because particularly as we move into retirement, inflation really matters, right? Because no longer can we hopefully, workers hope that we can get wage increases that will at least counteract some of inflation. Of course, that's a problem as we move into retirement. How can that actually impact us? The other thing is we have 20-year per annum returns projected forward for Aussie equities, global equities, other asset classes as well. But I just pick those two. So Aussie equities, as I said, we have higher expected future returns because valuation levels are lower. I think the market's cheaper than global equities, a lot of that made up of the US. But I bet you those two numbers are probably not what you have in your head. Because once again, we have recency bias. It sort of seems to be most people, you go out there and talk about what does the share market do every year, everyone just says 10%. Well, the difference between 10%, 6.75%, or 7.9% is pretty significant, particularly over the long term. So it's thinking about what would be the implications on our portfolio, however this plays out, if we got lower returns. All right, so we've got a couple questions that I'll get to. I don't want to go too past 7. I'm sure people have better things to do. Yeah, so Lisa said, will artificial intelligence reduce staff levels, increase profits for tech stocks? Very much people do believe that that is going to happen. We seem to have a little bit of a chat going back and forth of what's actually going to happen. But yes, certainly that is the view of some people. So we have Phil going back to the other side saying, I can't build power stations, bridges, or houses. That is very much true. It's obviously not going to eliminate every job. But I think once again, will enough efficiency from a company, and even if AI is not going out there and replacing all of the workers, the other question, of course, does that mean companies will stop hiring? Now, an argument we also have is, particularly in China, where we're seeing population growth start, from a demographic perspective, we are getting older. A lot of the world, right? If we look outside parts of Asia and Africa, a lot of the population is aging. So there probably will be less workers within working age. But yeah, a lot going on there. But people seem very into the AI. Can AI usefully intersect with wage growth? Absolutely. So it's a way to keep wage growth down, right? So, and that's what we saw with outsourcing, with offshoring. So it certainly keeps wage growth down. So does ESG become relevant? So Kate, I'm not exactly sure which side of ESG you're talking about. So that's environmental, social, and governance factors, of course. Social, okay, yeah. So I mean, I think it certainly can become relevant. So a lot of ESG we see sort of focused on the E, right? The environmental, but there's that social and governance factors as well. And yeah, the question is, will investors go out there and fund things that are doing poor things for people? Will those companies do well if they are creating situations that are bad for people. We will see. Once again, you just see so much of it focused on the E right now, and so much of it focused not necessarily from a technology perspective, but certainly from a social perspective on things like living wages and things like where you're sourcing your products from, and how, particularly if they're in different countries, they're treating their workers. I think the question is, what will people focus on? There hasn't been a lot of focus, and a lot of ESG is wrapped up in technology, right? Because technology is going to solve all the ills of the world. A lot of it has just ignored these technology companies and said technology companies are good on an ESG level. The question will be, as people look more into their products and sort of what they're doing, particularly around AI, we could see that. All right. Well, we've made it to 7 o'clock. So as I said, I'll do this again, 7 o'clock. We'll start ESG. Now I've got ESG in my mind, Kate. We'll start ETF month. So I'll be back next Tuesday, 6 p.m. Sydney time, to do something on ETFs, and we'll go back to our regularly scheduled 1 p.m. time for the rest of the month. So if anyone wants to sign up for that, has any questions, anything else, just send me an email, and I hope everyone has a great Tuesday night.
Any advice in this video is general advice or regulated financial advice under New Zealand law, prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited, without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.